Hi everyone, I hope that you're fine and in good health. In this video, I'll go over a couple of examples to illustrate how to calculate the weighted average cost of capital, or the WACC. I'm just going to go over a couple of problems, but of course there are several variations of these problems, and I would advise you to make sure that you're able to solve all the problems that are assigned to you. Before we delve into how to calculate the WACC, or the weighted average cost of capital, let's look at a couple of definitions. And I've copied and pasted the definitions from a couple of books to give you a broader overview of the topics. Alright, so first of all, what is the cost of capital? The cost of capital is the return the firm's investors could expect to earn if they invested in securities with comparable degrees of risk. A project's cost of capital is the expected return required by investors to hold the firm's underlying assets. It is the weighted average of the firm's equity and debt costs of capital. The WACC is the expected rate of return on a portfolio of all the firm's securities. Our WACC is an appropriate discount rate for the firm or for a project that is a replica of the firm. Knowing our cost of capital can help us determine our required return for capital budgeting projects. Okay. Help us discount cash flows. Okay. So here is the formula for the WACC. So we have our WACC equal WD times RD times 1 minus the tax rate plus WPS times RPS plus WCS times RCS, where WD is a proportion of debt financing, RD before tax cost of debt financing, tax is a corporate tax rate, WPS is a proportion of preferred stock financing, RPS is the cost of preferred stock financing, WCS is the proportion of common stock financing, and RCS is the cost of equity financing. So remember, interest is tax deductible, and obviously we have to take taxes into consideration when we are calculating the after-tax cost of debt. So let's start with the most basic problem. So we have calculating WACC. Johansson Corporation has a target capital structure of 75% common stock and 25% debt. Its cost of equity is 12.1% and the cost of debt is 6.3%. The relevant tax rate is 35%. What is the company's WACC? So in this simple problem, everything is already given to us. The weights are given to us. The cost of equity and the cost of debt is also given to us. So we just simply plug in this formula and calculate our WACC. Okay, so we have our WACC is 75% times 12.1% plus 25% times the 6.3% times 1 minus the tax rate, and that gives us an RWACC of 10.1%. So as you can see in the simplified problem, the cost of equity, the cost of debt, and tax rate, everything is already given to us, and so it was fairly easy for us to plug everything into the formula and calculate the WACC. But what if the cost of equity and the cost of debt or the cost of preferred stock are not given to us? Then what do we do then? Can we figure them out? Well, the answer is absolutely we can, but we have to kind of remember some of the concepts and models that we had learned in previous chapters or prior classes in order to figure out how to solve for the cost of debt, the cost of equity, and the cost of preferred stock. If you need a refresher, please watch my short videos on stock valuation, bond valuation, risk and return. Links have been provided in the description below, but I'm going to give you a super quick rundown of the procedures we can use to calculate the cost of equity, debt, and preferred stock. So the cost of equity. Okay, the cost of equity is the return required by equity investors given the risk of the cash flows from the firm. And there are two major methods for determining the cost of equity: the dividend growth model and the capital asset pricing model. Okay, so the dividend discount model, or the DDM, looks like this. If you remember, P0 equal dividend 1 divided by R minus G, where P0 is the price of a stock at time period 0, dividend is the year 1 dividend, expected dividend year 1, required return minus G is the growth rate. Okay, so if we rearrange the formula, our R of equity is going to be a dividend year 1 divided by the price at time period 0 plus the growth rate. Okay, so this is how we calculate, one of the ways we can calculate the R of equity. Another way we can calculate the R of equity is by using the capital asset pricing model that is developed by William Sharpe. And the formula for calculating the required return on equity using the capital asset pricing model is as follows: R of I equal RF plus beta of I, RM minus RF. Alright, so RF is the risk-free rate, beta is the beta of the security, RM is the rate of return on the market, RF again is the risk-free rate of return, and RM minus RF, remember, is the market risk premium. So again, depending on the question, we can either use the DDM or the CAPM, and I've talked about the pros and cons of each of these models in my notes, so you can review that. Next, we have the R of debt, and the R of debt or the cost of debt is nothing but the yield to maturity on a bond. And you can use the financial calculator, the Excel, or you can use the approximate formula for calculating the yield to maturity of a bond. Then we have the R of preferred stock. So preferred stock is a perpetuity, so its price is nothing but the dividend divided by the required return. Okay. And again, if we rearrange the formula, we have the R of preferred stock equal dividend divided by the price. So now we're going to look at a problem that's a little bit more intermediate than the one we just did, the very simple problem. And most of the WACC problems can be solved by using these three steps that I'm going to show you below. So you have number one, calculate the value of each security as a proportion of the firm's market value. Number two, determine the required rate of return on each security, stock, bond, or preferred stock. Number three, calculate the weighted average cost of capital. Okay. So now let's look at this example. It says Mackay Metals Corporation has a 9.1 million shares of common stock outstanding and 2% semi-annual bonds outstanding, par value $1,000 each. The common stock currently sells for $41 per share and has a beta of 1.2, and the bonds have a 20-year maturity and sell for 104% of the par. Market risk premium is 7%. T-bills are yielding 3.1%, and what is a WACC? So again, step number one, calculate the value of each security as a proportion of the firm's market value. So basically we have to calculate the weights. So let's calculate the weights for bonds and stocks. We don't really have preferred stock here. So we'll begin by finding the market value of each type of financing. So we have the market value of bond is 230,000 times 1,000 times 1.04, because as you know, the bonds sell for a percentage of the par, and in this case 104% of the par. And there are again 230,000 bonds. Okay. So you can see the market value of the bond, and then similarly we find the market value of the stocks, 9.1 million times $41. And we calculate total market value by calculating market value of bonds plus stocks. Okay, so we have the market value of bond plus the market value of stocks equal total market value, and then we find the weights. Okay. So the weights are again. So the weight for bond, or the proportion of debt, is about 39.07%, and the proportion of stocks or weight of common stock is about 60.93%. And what we're basically doing is we're taking the market value of the bond, dividing it by the total market value, taking the market value of stock and dividing it by the total market value. Alright, the next thing we have to do is to find the cost of debt and the cost of equity. So if you look at this problem, we see that, well, the beta is given to us, the market risk premium is given to us, and the yield on the risk-free rate or the treasury bills rates are given to us. So, which model do we use? Do we use the DDM or the CAPM? And obviously we're going to use the CAPM because, all the variables that we need to calculate the CAPM are given to us. So let's see, so we calculate the cost of equity using the CAPM. So RCS is 3.1% plus the beta times the market risk premium, which is 7%, and that gives us the RCS of 11.5%. Alright, the next thing we do is to calculate the cost of debt, which is again the YTM, or the yield to maturity, and we can again either use the financial calculator or we can use our approximate formula. And it's a semi-annual coupon paying bond, so it's 20-year bond, which is 40 periods. Present value is 1,040. The payment is again semi-annual, 6.2% or $31. The face value is 1,000, and we calculate the I by Y, which is the yield to maturity. Okay. And multiply it by 2 because we need the annualized yield to maturity, which is about 5.86%. And of course, remember, we have to take taxes into consideration, and so our after-tax cost of debt is that over here, 5.86% times 1 minus the tax rate, which is 3.81%. Alright, so we're done with step 1. We've calculated the weights. We're done with step 2, determine the required return for each security. In this example, stocks and bonds, and then we can now proceed to step number 3, calculate the WACC. Okay. So now we go down and we have calculate the WACC. Again, we can ignore this part of the formula because we don't have preferred stock in the problem. So we have our WACC is WD, weight of D, times the after-tax cost of debt plus weight of common stock times the cost of equity. Okay, so we have equal the weight for the equity times the cost of equity, plus again the weight for bond times the after tax cost of bond, and that gives us an RWAC of about 8.49%. Okay. So as I mentioned, there are several variations of these WACC problems, so make sure that you're able to solve all the problem that I've assigned to you. If you need a refresher again, you can go over the links that I've provided to you in the description box. What I've given you is a rundown of the topics, but you can go over my lecture notes and the text for in-depth discussions and for a thorough understanding of the topics that we just covered. I hope you find this short video very helpful and learn how to calculate the weighted average cost of capital after watching this video. Let me know if you have any questions. Take care and stay safe. Thank you.